A credit card is a useful financial tool. If you understand how it works, you can make it work for you. After completing this video, you'll be able to understand how to obtain credit, compare credit card offers, as well as name the pros and cons of using credit. In addition, you'll be able to explain what is wrong with making just the minimum payment on a credit card. So what is credit? When you buy on credit, someone, the store, or maybe a bank, loans you money. You become the borrower and the business or bank becomes the lender or creditor. The creditor will expect you to pay interest, a preset percent of the purchase amount, as the monetary price for the use of the money. For creditors, a credit card is a convenient way to loan money for everyday consumer purchases, such as clothes, gasoline, or restaurant meals. For consumers, plastic is also very convenient. Just swipe the card at a checkout line and pay for every one on 1 month bill. An interest rate is the fee, expressed as a percentage, a borrower owes for the use of a creditor's money. At an interest rate of 10%, a borrower would pay $110 for $100 borrowed. Let's take a look at the following example. Suppose you use credit to buy a jacket for $100. If the interest rate is 15% per year, you must repay $115 at the end of the year. We came to this conclusion by taking $100 and timesing it by 0.15 for 15%, which equals $15. Then we took the initial price of $100 and added the $15 to get $115 total. So you're technically giving up $115 worth of future spending for the ability to spend $100 now. Credit cards and debit cards often look the same. Both carry similar logos such as Visa or MasterCard. You can use both of them in the same way when making a purchase. So does it really matter what type of card you use? Despite their similar appearance, credit cards and debit cards work in very different ways. When you use a credit card, you are borrowing money to make your purchase. You'll receive a bill later, and if you cannot pay the full amount of your purchase by the due date, you'll be charged interest on the loan. A debit card provides a way to use your checking account. It's like writing a check, only faster. When you use a debit card, your bank will debit or subtract the purchase amount from your account. Credit cards let you buy things you couldn't otherwise afford. This can be fun for a while, but not when you realize you're deep in debt. Credit cards can be a big help in an emergency. If you're facing a large, unexpected expense that is more than you can cover with your checking or savings accounts, a credit card can give you more time to pay. They are useful for making purchases online or over the phone. Responsible use of a credit card helps you establish a good credit history too. This can help you in many ways in the future, such as in getting a job you want or a good deal on a car loan. If you pay your credit card bill in full every month, you can avoid finance charges. In effect, you can borrow money, if only for a short time, for free. Finally, credit cards are convenient. You can buy what you want without the need to carry around a large amount of cash. Convenience can sometimes carry a price, however. Using credit has disadvantages, such as it's easy to buy more than you can afford. In addition, interest rates on credit cards are usually high, especially for young people who haven't yet established a good credit history. If you do not pay your bill in full each month, then you actually have a high interest loan. Credit card companies allow you to make a small minimum payment each month, but be aware. If you regularly make only minimum payments, your balance can continue to grow even if you do not put any new charges on the bill. Using credit card and making only minimum payments is like digging yourself into a deep financial hole. So how do you get a credit card? Applications for credit cards are easy to find. Most people get plenty of them in the mail every week. Be smart. You'll do better if you learn the differences between credit card offers and think about how you plan to use your card. Then go shopping for a credit card that meets your needs. Credit cards are available from banks, credit unions, and many businesses. To get a loan, you must demonstrate your credit worthiness to a lender. Credit worthiness is basically a measure of your reliability to repay a loan. To be creditworthy, you must have the ability and willingness to pay your debts. Lenders take into account many different financial areas for a borrower prior to giving them credit. These areas are known as the 5 C's to creditworthiness. They include character, capacity, credit history, capital, and collateral. The first includes character. This means the borrower is trustworthy to repay the loan based on their education, did they graduate high school and/or college, their background, business and previous experience, are they working or have they held a position for a long period of time, as well as their references. The second C to creditworthiness is collateral. This includes additional items of value you can provide the lender if you're unable to pay your loan. Giving a lender collateral means that you pledge an asset you own to the lender with the agreement that it will be a repayment source in case you can't repay the loan. The third C to creditworthiness is conditions. Conditions describe the intended purpose of the loan. How will you spend the money you are asking for from the lender? The fourth C to creditworthiness is capacity. Capacity is your ability to repay the loan. It includes your available cash flow, timing of your payments, and existing credit relationship. Finally, the fifth C to creditworthiness is capital. This is your personal investments. This is an indication of how much you have to risk should you experience job or other income loss. When you want to borrow, you'll be required to complete an application form. The information you provide on the form helps the lender determine your credit worthiness. On this form, you must list your assets, such as checking account, savings, real estate, car, cash, etc., and your liabilities, credit cards, auto loans, mortgages, home equity, etc. Whenever you apply for credit, make sure you understand the terms. Fortunately, the federal government requires credit card companies to disclose their terms in a box somewhere on their application. One of the most important terms is how much interest you'll be expected to pay. The interest rate on a credit card is expressed as APR, or annual percentage rate. You can use this APR information to compare credit card offers. Many cards are advertised with a very low APR, but read the disclosure box before you apply. That low rate is probably an introductory rate that is in effect for just a few months or even less. After the introductory period, the APR will increase. The disclosure box will tell you how long the introductory rate will be in effect and what the rate will be afterward. Your monthly credit card statement will include all of the purchases you charge to the card during the month, as well as any fees or finance charges. The bill will show the total amount you owe plus the minimum payment you must make that month to remain in good standing with the creditor. We have now completed the video. Once you have completed the entire lesson in video, you should be able to understand the process of obtaining a credit card as well as the advantages and disadvantages to owning one. In addition, you should be able to identify the concepts of APR, principles, as well as introductory rates.